Picture this, a single sheet of paper, a handwritten to-do list, and one line on it, big enough to read from clear across the room. Buy Japanese yen, 5 to 10 billion. It was sitting right in front of the U.S. Secretary of the Treasury, and a photographer across the room with a long lens caught it. 11:33 in the morning, July 31st. That same Friday, for the first time since 1998, America walked into the currency market and bought yen. And the only receipt? A doodle on a notepad. Here's what makes this wild. The rate America pays to borrow money for 30 years just hit its highest level since 2007. And the country we're rushing to prop up? They hold more of our national debt than anyone else on Earth. So the question kind of writes itself. Why are we doing this? What are we actually buying? Here's President Trump on Air Force One explaining it in his own words. Basically, we have a good relationship with Japan. They've got a weakening yen, they wanted a little help, and we're always there for them. Japan's been very good to us, with the exception of Pearl Harbor. Friendship, financial strength, and Pearl Harbor, all in one breath. If that's not the most Trump thing you've ever heard, I don't know what is. Tokyo got asked the same thing. Their answer was way stiffer. Japan's finance minister said the move was done in coordination with the U.S. Treasury to counter excessive volatility and disorderly movements in the yen. Translation? The yen was falling. Japan was hurting. And America stepped in to play daddy and make the pain stop. Which brings up a good question. Where does a government even get the money to buy a foreign currency on a Friday afternoon? The answer is a pot of cash at the Treasury called the Exchange Stabilization Fund. And here's the crazy part. The Secretary can spend it without asking Congress. He just needs the president's signature. That's it. The credit card opens up. It was created for one job. It's right there in the name. Stabilize the dollar. But throughout history, that's rarely how it gets used. One Treasury secretary reportedly dipped into it to buy an oriental carpet for $8,000. Another took a trip to London, Moscow, and Mexico City. 42 people. $131,000. No official purpose anyone could ever figure out. Think of it as the Treasury Secretary's personal piggy bank. No Congress, no oversight. And get this, the law literally says his decisions are final and may not be reviewed by another officer or employee of the government. But here's the part that actually matters. America didn't buy those yen with dollars. It sold euros. Roughly 13 billion of that fund is held in euro assets, and that's what went out the door. America sold Europe's currency to buy Japan's. And the European Central Bank? They only found out after the trades cleared. Senior European officials told the Financial Times this broke decades of convention. It had never happened before. The Treasury's response when asked? They said they don't coordinate with anyone on how they use the fund, which is true, but it's also basically pleading the fifth. Oh, and one more thing. Just 8 days before all this, the Treasury published its official watch list. You know, the one that tracks trading partners to make sure they aren't manipulating their currency. And guess who was right there on that list? Japan. So let's recap. America broke a 28-year rule, paid for it by dumping Europe's currency, only told them after the fact, and did it all for a country it flagged as a currency risk the week before. Why? Well, a while back I made a video about one of the biggest threats to the U.S. economy, Japan quietly walking away from our bond market. And that's the reason. To get why Japan matters so much, you have to understand what they would have had to do if we hadn't shown up. Japan owes more, relative to the size of its economy, than any major country on the planet. And this year, just the cost of paying interest on that debt jumped nearly 11% to 13 trillion yen. And right as that bill is exploding, the yen crashed to 40-year lows. Why? Honestly, it's simple math. For decades, Japan kept its borrowing costs pinned near zero. But recently, they started rolling that back. Their rate now sits around 1%. Ours sits closer to 4%. And that gap? That's the whole story. Because capital doesn't catch feelings. It's not your clingy ex. Capital goes wherever it gets paid the most. So investors dump the yen, chase the bigger returns in dollars, and drive the yen right off a cliff. Now here's where the armchair economists show up. Just raise interest rates and close the gap. Problem solved. Except they can't. And here's why. To hold rates at zero for so long, the Bank of Japan had to buy its own government's bonds, trillions of them, year after year, until it owned about half the entire market. A country that solved its debt problem by buying its own debt. And those bonds pay almost nothing, because paying nothing was the whole point. But the second Japan raises rates to save the yen, it starts paying out trillions in interest, while still earning almost nothing on that giant pile it's stuck holding. You don't need a finance degree to see that's a terrible deal. So Japan's got two choices: defend the yen or afford the debt. It can't do both. which leaves exactly one move. Currencies trade in pairs. Want one to go up? You buy it and sell the other. And since the dollar sits on one side of nearly 90% of all currency trades, buying yen almost always means selling dollars. Good news for Japan, they've got dollars. They're the biggest foreign holder of US debt, more than the UK, more than China, more than anyone. Bad news? Most of those dollars aren't just sitting in a checking account. Now, quick pause. If you've watched my channel, you know I love data, because without it, you're just guessing and calling it analysis. The problem? That data is scattered across 100 websites that look like they were built in 1998. Which brings me to today's sponsor, Oxy Labs. Over at oxylabs.io/casualfinance, Oxy Labs is a web intelligence platform that does the data collecting for you. With their web scraper API, you can pull real-time data from search results, e-commerce listings, or almost any public site using over 175 million proxies across 195 countries. No servers, no setup. Head to oxylabs.io/casualfinance for a free trial, up to 2,000 results, no credit card, and use my code CASUALFINANCE for 20% off. Thanks, Oxy Labs. Now, back to it. Of Japan's roughly 1.3 trillion in reserves, about 930 billion is tied up in securities, mostly US bonds. And a bond isn't cash. You can't hand a currency dealer a treasury bond and ask for change. So Japan had two options: sell them or pawn them. And Japan chose to sell. Over 1 month, they launched the biggest currency defense in their history, nearly $74 billion in 4 weeks, all from selling down US bonds. In May alone, Japan's holdings dropped by $66 billion, the single largest one-month sell-off by any country ever. And it worked for about 3 weeks. Then reality hit. See, when you flood the market with bonds nobody asked for, the price drops, and the government that issued them has to pay more to borrow. So Japan sells our debt, our borrowing costs go up, the gap gets wider, and capital keeps flowing to America. Every dollar Tokyo raised to lift the yen made the reason it was falling slightly worse. It's called the doom loop, a machine that eats its own tail. And suddenly, this wasn't just Japan's problem, it was ours. Our biggest lender just showed the whole world it's willing to become a seller, which is exactly what you don't want your biggest lender doing. So somebody had to build a second option, and somebody did. There's a tool at the Fed where a foreign government hands over its US bonds, takes dollars, and buys them back later at a slightly higher price. It's a pawn shop for governments. It gives Japan a way to raise dollars without ever becoming a seller. It's what you build for a creditor you cannot afford to lose. Which brings us back to July 31st, because 48 hours after the operation, Treasury Secretary Scott Bessent hopped on Twitter and said that pawn shop facility is an important backstop and urged the Fed to expand it. But here's the weird part. Nobody was even using it. The balance? Zero. Untouched for 8 straight weeks. So he wasn't asking for more room because he ran out. He was asking the central bank in public, 48 hours after a currency operation, to build capacity for something that hadn't happened yet. You don't do that unless you know something's coming. And maybe that's just my read. Maybe I'm connecting dots that aren't there. Except, I'm not the only one. A guy who spent nearly 4 decades inside the US Treasury wrote that beyond just helping a friend, the real worry was that a weak yen could push American interest rates higher. So the president says friendship, the Treasury says stability, and the man with 40 years on the inside says there's more to this story. And here's the funny thing. None of it is hidden. A data release, a tweet, a blog post, a photograph. It's all public. You just have to dig. That's why I made this channel. I like doing the dirty work. I read the boring documents so you don't have to. And then I tell you what's buried inside them. If that's worth something to you, hit subscribe. Because of everything in this whole story, the one thing that told you exactly what was happening, with nothing hidden underneath, was a handwritten to-do list nobody was ever supposed to see.